Okay, I'm going to go into a segment from our recent webinar, which you can get on demand today. We're going to talk about something we just introduced in this series of webinars, the orphan stock opportunity, essentially defining what is an orphan stock, how do you identify one, unique opportunities, and I'll provide an example as well. So um, I'm going to start off just defining that. What are orphan stocks? These are stocks, often small caps, that have been ignored by the investment community. As a result, may be trading at low valuations measured against their current or future prospects. We consider them higher risk, estimated to be 50 to 100% plus undervalued to compensate for this risk. So a minimum of undervalued 50%. That is a significant opportunity for gains if properly identified. And we're going to show some examples, I will today, from the past. So again, continuing on what is an orphan stock? Well, these are extremely rare. We find about 2 to 5 annually after researching 5,000 plus stocks. In theory, the markets are all about efficiency. So a stock trading at, say, a 50% discount to its intrinsic value is definitely an anomaly. That is what we are trying to identify here. Orphan stocks have the potential to provide an element of higher risk growth that can be lacking in the average Canadian stock portfolio. So why does a stock become orphaned? Well, there are a number of reasons why a stock can become orphaned, but chief among them would be a lack of value creation from a shareholder perspective. Over the long term, I would say fundamentals are like gravity. If your stock creates consistent per share cash flow, often per share free cash flow, the stock price tends to stick to it like glue and rise over time. This is shareholder value creation 101. If the business of the stock you own does not create shareholder value long term, this is what I put on the screen here, by committing a number of what we call Keystone's stock sins listed here. That would include possessing no revenue or limited revenue, limited to no historic profits, weak margins, limited or negative growth per share, or just a poor business structure. Basically, these sins, stocks that have to do these things, essentially the antithesis of what we are looking for in a great long-term stock. Now, if a stock continuously does these things or performs these symptoms or has these symptoms over the long term, it can become orphaned or ignored by the market. Now, what would change a floundering business into an orphan opportunity? Well, a fundamental change in the business that really dramatically alters the company's profitability equation, a catalyst that brings about change through a spike in profitability, which is what ultimately drives stock prices. So how do we identify orphan stock opportunities? Well, there's no magic button or simple formula to help you discover these market anomalies. Your best weapon is brute force and volume. We come across, say, 2 to 5 of these opportunities annually, like I said, from looking at thousands of companies. But how do we look at these and how do we identify these orphan opportunities? You want to study the disclosures, conference calls, presentations, financial statements, conduct investigative interviews when potential catalysts present themselves of thousands of public companies, essentially to identify these anomalies before they are broadly identified. What we want to do is exploit the inefficiencies at the less followed end of the market. What is the process here? Well, once we identify a potential orphan stock opportunity, often we will wait until the catalyst takes hold to confirm our thesis, awaiting the release of at least one set of quarterly financial results before we step up and buy. This confirmation helps allay some of the execution risk and helps prevent becoming stuck in an investment concept that continues to suffer from failure to launch. While one may think the release of a strong quarter would immediately become priced into the stock, in most cases, an orphan stock by definition has little in the way of a following, and therefore the initial stages of the catalyst opportunity are often acted upon by no investor of consequence. The de-risking gain from the confirmation most often outweighs a slightly higher entry point and the downside of moving too early and becoming stuck in a liquid stock that does not deliver on the potential catalyst. Once confirmed, however, we can act swiftly. We are ready with a buy recommendation immediately, which includes a buy range, rationale, and potential time frame for investment. Now, for proof of concept in reference to orphan stock opportunities, I present NTG Clarity, NCI, and the TSX Venture. This is a digital transformation business providing telecommunications, engineering, information technology, networking, and related software solutions to clients in the enterprise, telecom, utility, financial, IT, and government sectors. 95% of the revenues come from Saudi Arabia with no exposure to tariffs at present. The company was recommended in July of 2024. The recommendation price, as we can see here, 78 cents. Now I'll talk about its current fundamentals. I did later in the presentation, but as a case study today, we look at the business ahead of our recommendation just 9 months ago. Why at that time was it orphaned? What the opportunity was and how it has performed since. So why was NTG Clarity orphaned or ignored by the market? Well, for 9 years, between 2014 and 2022, NGD failed to produce anything close to consistent growth. 2014 revenues were 15.5 million, and by 2022, the company had grown revenues just marginally to 17.7 million, with a low of 7.9 million in 2020. Profitability and margins were weak, with more years producing a net loss than income. The profile was not that of a company that should attract investor attention. The stock was orphaned, suffering from low volumes and rightfully so a lack of investor interest. So fast forward 2 years, the catalyst appears to have taken hold, powered by a promised $1.3 trillion in investments in technology by the Kingdom of Saudi Arabia and a massive digital transformation. NTG had posted significant growth, backed by a low-cost labor force in Egypt, introduced strong growth guidance for 2024, backed by a record backlog. And we received confirmation in the form of a breakthrough quarter, 6 cents in earnings delivered in EPS in the company's Q1 2024, up from under a cent in Q1 2023, higher margins, higher EPS, and we had part of our confirmation. Now let's look at the fundamental value and growth equation that led us to believe NTG Clarity was an orphan stock as a good case study here. So in July of 2024, the stock traded around 78 cents. Now, based on management's guidance, our initial earnings estimate was in the range of around 13 cents. Based on this, the forward PE was in the range of 6. Now, our fair value was based on a low multiple of 10 times our 2025 initial estimate, about $1.30 at that stage, a 68% potential return, falling into our return requirement for a higher risk orphan stock. Shortly after, we issued a buy report at 78 cents. Now, in less than 10 months since, the stock has then posted 2 more record quarters and has jumped 133%. Currently trades anywhere from $1.65 to $1.80 in that range. And we have increased our 2024 and 2025 estimates based on the current record backlog. So that gives you a good idea of the strong potential gains that we can deliver investing in this special class of small cap stocks. Now, in the full presentation, we also went on to introduce a company that we believe right now is an excellent orphan stock opportunity.
And you end it with a teaser.
Oh, always. I'm a bit of a tease. That's what they call me, right? I know, it's true.
Yeah, but people can access the DIY on demand and get the name of that
they
stock.
Can. I heard they can. Go to our website. Yeah, no, and we talked about it at the start. I mean, the company we're looking at now, that essentially in January of this year, I think nobody was paying attention to that company. They're benefiting from the strong uptick in terms of the price of gold, and we thought they were going to earn 20 cents per share, and at the start of this year, they were trading well under $1. So you're buying them 5 times. A typical, it is. We don't find a lot of these, but that is an orphan stock opportunity, and you can see NTG has more than doubled over the past year, which is great to see.
Yeah, no, I was just going to say when we do find them, they're across industries. It's not just one set industry. People will always think, oh, you need to look here, X, Y, or Z, whatever bias they have towards. They are widespread, and that's the difficult in finding them. Is you need to realize things will be overlooked, every little nook and cranny, but it's not one set area. It's not just whatever technology in NCI's case.
Yes, we wish it was. You could just look in one area, technology, or all gold stocks, or all oil or all, real estate related REITs or something to do with that. But no, we are, and all of our analysis is sector agnostic. We look across sectors, but yeah, you're leaving no stone unturned. I mean, you literally have to look up. I mean, some of them, whether it's just obscure name, no profitability, and then broke through. I mean, these companies that have been around for decades and then suddenly there's something that changes the business. Then you've also got to be careful, because on the flip side, you see a business that might have one quarter that is just an anomaly because of market conditions that aren't repeatable, right? So, and that's what you got to be careful about. I mean, we saw that sometimes during the pandemic. There were some companies, like there were hand sanitizer related companies. We looked at one company looked tremendously strong at one point, and it looked like, okay, well, wow, this is trading at reasonable valuations, but that was a one-time event that wasn't repeatable, and the stock fell off a cliff after that. So you had to be aware of those things in that period. You got to be aware of what's going on in the market. Is it sustainable?
What I would say as well is just like, a screener, a stock screener isn't going to pick these things up. Like we are going through the financial statements of all of these companies and, they divested a piece of their business. Now they're expecting profitability or whatnot. And even like that, that hand sanitizer company that Ryan's teasing, we were considering recommending it. It had significant net cash on the balance sheet, huge cash balance. But we didn't end up recommending it. The stock ended up pulling back. And even I remember when we were looking at it, Ryan was saying to me, this could potentially be a takeover target just because of the beautiful balance sheet. And, I believe the stock did pull back, kind of following that pandemic hype with hand sanitizer. But, the stock did end up getting bought out, eventually. Again,
probably got bought
we're not
for
going
the manufacturing facilities, to be honest. Like, yeah,
well,
the cash
and exactly.
balance sheet, yeah.
Mm-hmm.
Yeah.
But yeah, that's the thing. You always just got to be looking for these little opportunities out there. And, although we might not, recommend that one, like the hand sanitizer one, it's on our radar. We're monitoring it.
Yeah. And typically, like, the best business you want to buy is the one that you can see consistent long-term growth in, or, over a 5, 10, 15, 20, 30-year period. That's what you look for. If we're doing a ton of research and we can come up with these little anomalies that may be trading, at a 50% discount to intrinsic value, we can add that too. It's certainly higher risk. These type of companies are higher risk, and we have to note that anytime we, make a recommendation in these of these types of stocks. But they come in all forms and all across businesses, and there are unique reasons why a stock may become orphaned. But we're always looking, and if we can find one or two a year that have that discount to their, what we'd say, their intrinsic value, and have potential for significant upside, it's something you can add to your portfolio. Certainly we want to focus more on the long-term cash generating great businesses, but this is a little element that we kind of added to our webinar as just to show investors that there are other types of investments that you can look at in the markets that we can find that are probably priced below where they should be fundamentally.